Alright, as promised, I'm making a couple of videos on options contracts. I wanted to state very clearly I am not a professional. This is not financial advice. You need to do your own due diligence and trade at your own risk. Let's go ahead and get started. Moving on to the first slide here. What is an options contract? If you're new, I want to be able to bring you up to speed a little bit. If you already know a lot of this stuff, bear with me. Maybe skip this video even. But tomorrow we're going to be doing, or I'm going to be putting together a simulated trade and going into some of the Greeks, a little more complicated topics. Today it's pretty basic, just getting the grip of what a contract is, how they're used, and what all the verbiage is really. Now there are two kinds of contracts. There are calls and puts. In a call, the buyer is purchasing the option to buy shares from the seller. In a put, the buyer is purchasing the option to sell shares to the seller. Calls and puts. And you can sell or buy both. And it gets a little complicated, it gets a little confusing, which is bullish, which is bearish, etc. But the concept here is that the buyer of the contract has the ability to exercise that contract. And exercise means the fulfillment of the terms in the contract, i.e. buy or sell shares. And this could be good. You can imagine if you have a contract to buy 100 shares at $40 and the price rises to 80, that's a pretty good deal, right? To be able to buy those shares for $40. Inversely, if you have a put to sell shares for $40 and the price falls to 20, obviously being able to sell at 40 has a lot of value to it. So those contracts also have premiums that show that value. And those premiums are split into extrinsic and intrinsic value. Alright, because there's always going to be that value between the strike price of the stock and of the contract and the actual price of the stock. That difference is going to be the intrinsic value. Then there's extrinsic value, which represents other things. And that's kind of where the Greeks come into play and such. So there are calls and there are puts. Why do we use options? I'm going to play a video here by TD Ameritrade, and I really recommend spending some time in their investment center, or their educational center. It's been amazingly beneficial for me. I've spent so much time there. It's an exhaustive library of videos, references. I really recommend it. Let's go ahead, watch this.
Options trading is an alternative way for investors to invest in the performance of a security, such as a stock or an ETF. By trading options, an investor attempts to capture the up or down movement of a security while only investing a fraction of the cost it would take to own the actual security. For example,
alright, that's the point. That's the first point right there. That you don't have to buy 100 shares of the stock. So if the stock's $40, you want to buy 100 shares, you can pay $4,000. Or you could buy an options contract for a few $100s. And that way, if your investment does go south, you've risked less capital.
Consider a stock that's currently trading at $100. If you purchased a share and the price went up $5, you would have a 5% return. With the right option contract, you could profit from this same jump in the stock price while only paying a small premium that costs significantly less than the price of owning the stock.
And so the ratio of the profit versus the initial investment is higher, and that's why you see these gain porn posts with thousands of percentages. Is because the nature that the investment is leveraged. The initial investment is very small, but you still make the money on the overall stock price movement.
The ability to make more with less is one of the benefits of options trading. However, the potential for greater profits comes with greater risk of losses. To help you understand why, let's take a closer look at how an option contract works. Unlike a stock, when you buy an option contract, you're not purchasing the security itself. Instead, you're purchasing a contract that gives you the right to buy or sell a security at a certain price before a certain date.
Alright, there you go. That's the nuts and bolts of a contract right there.
Consider this example. Suppose there's a coffee shop chain called Stone Curb Coffee. Stone Curb stock is currently trading at $50 a share. An investor believes that the stock price of Stone Curb will rise.
They like the stock.
This investor considers taking advantage of this anticipated price movement by buying 100 shares of the stock, but she is concerned about the initial capital requirement. Now, let's assume that there's another investor. He already owns 100 shares of Stone Curb stock and plans to hold on to it for a while. He thinks that the stock price will not increase much over the next few months. Both investors can utilize a call option. This type of option contract gives the buyer the right to buy shares of Stone Curb stock at a set price, called a strike price, at a set time, called expiration. In this case, it's $55 per share in 4 weeks' time. Typically, each standard option contract represents 100 shares, so this one contract would give the buyer the right to buy 100 shares of Stone Curb stock at $55 per share. The buyer purchases the contract by paying the options premium. The premium, or price of the option, is determined by several factors, including the stock price, time until expiration, and implied volatility.
I'm going to go ahead and stop it right there. You see the stock value and then time value up there. They're basically trying to show the intrinsic and extrinsic value and how those two different values are the premium. And that comment about implied volatility, that's what I've been saying all week. Implied volatility is a big deal when it comes to options contracts and the pricing of those premiums.
Stock is expected to.
All right, so why use options? I think there are basically 5 reasons why you would enter into an options contract. The first is to enter a position in underlying security, with, of course, the safety of risking less initial capital. The second would be to exit a position, and that would be a more strategic move. Per se, you're worried that the price, if it falls below a certain support level, will drop much further. You could sell, or you could buy a put at that level, and that would be like an exit, like a stop loss. You could hedge potential losses, augment gains, and speculate. So these are the 5 reasons why you could enter into an options contract, or reasons which you may wish to do that. Next slide. Let's take a look at deep fucking value. What are we looking at? His last YOLO update. Look at this. He buys shares at $55 while the current price is $154. That is exactly what you want to do, if you can, is know when the stock is undervalued and then use a leverage instrument like a call to really increase your gains. Being able to buy shares at $55 when the price is $150 is incredible. That's a much safer entry into a long position than buying at market, obviously. You're going to see he had 200,000 of these shares. The idea here is that he had 200 call options. That's a lot. And if deep fucking value can learn to use options, I think everyone else can too. It's great having watched him and his his journey. Good for him. I'm so happy for this guy. It's just incredible. Look at these awards too. Moving on. Okay, the anatomy of the contract. I want to talk about what constitutes, or what different aspects of a contract exist a little bit, because it's important to understand the nature of the contract in order to be able to trade it wisely. So every contract has an underlying security. It's almost always going to be 100 shares of the stock. Almost always. The strike price is the price at which the shares are bought or sold. Expiration date the contract must be exercised or closed. The premium is the cost of the contract. And then there are Greeks, and these are different variables used for calculating the price. And it makes sense, but the Greeks make very little sense in terms of being understandable. Like, why are they called Greeks? I mean, they're variables, yes, but it makes a lot more sense when you talk about it in a more colloquial way. Like, let's say I have a $40 call, and the price of the stock has been under $40 for a very long time, and the expiration is rapidly approaching. Obviously, an agreement to buy shares for more than what they're priced at market is increasingly less valuable the closer that expiration date comes, because the odds that the price will then rise above that strike level diminishes, okay? And that would be an example of theta, right? But when you say theta, there's no implication of time value there at all. So that's why I say the Greeks don't make a lot of sense. They do make sense in technical terms, and if you're into math. I don't know why we need to call them Greeks, though. I'm going to move on to the next slide. Having a closer look at the options chain now. You're going to see here this little picture of this. It's not a little, but it's a screenshot of as much of the options chain as I could fit on my screen. AMC has a robust options chain. It's incredible to see this many strike prices, such a range of strike prices actually, and such volume. This makes the options chain an extremely tradable situation. There are other stocks, like take American Eagle for example. if you go look at American Eagle's options contract, the chain is much smaller. Seeing these kinds of chains is beautiful. I love it. So what I have done is I've taken a small portion. I've taken half of this options chain and just a few strikes, 3 strikes, and I've blown them up so I can walk you through them a little bit. Now this yellow writing on the left hand side to 26 November 21, that's the expiration date. You're gonna see it's a weekly, and that 6, I believe, is that it was a 6-week contract when it was written. It was written to expire in 6 weeks. And it says 100, that's for how many shares. You're gonna see volume, open interest, bid, and ask. Volume is how many of these contracts are trading in a day. Open interest is how many of those options contracts have not been exercised. The bid and the ask is the price you will pay to sell or buy the contract. I have, again, the expiration here, and then the strike on the far right. 2 of these are purple and 1 is black. That's because 2 of these strikes are in the money. That means that the price of the stock is above the strike price written into the contract. And so the price having ended at, I think it was above $40, puts both of these into the money. So in these prices, there is both intrinsic and extrinsic value. And I'm going to go over that next. So per Investopedia, intrinsic value measures the difference between the market price of an option and its intrinsic value, which is the difference between an option's strike price and the underlying asset's price. Okay, so if you have a call option for $40 and the stock price is $41, all right, there is $1 of intrinsic value in that option. So for instance, here, let's just say, we have $1 of intrinsic value here, and the bid and the ask are over $1 above that one, like $2. So there's like $1 of intrinsic value and $1 of extrinsic value. This is interesting too, really quick. I just want to comment. Look at the volume here on these strike prices, and then the open interest, and how low the open interest is for this contract, right? This is really telling here about what's going on in the marketplace. You can see that this is probably shares being exercised, right? They buy them, and then they exercise them, and the open interest goes down. It's also possible that this is selling, but having seen that contract go into the money like that, you don't think you would see many people selling, but you never know. I do think that this is an interesting situation here, and that this could be read into a little bit. Maybe I'll do some studying and look at those volumes more. But moving on from that, that's the gist of extrinsic and intrinsic value. Now I have a chart here. This compares the price of AMC to the December 3rd $40 call of AMC. The call is in this purple, and the stock price is in the cyan. And it's actually charted in percentages, because obviously you can't put these two things together on a chart. They just won't line up on the y-axis. What you're going to see is a yellow line. This is $40. This is the strike price. And I'm going to walk you through how this call options value relates to the price of the stock. So you're going to see in cyan, the line drops on the left-hand side and falls below that $40 strike price. And look at what the value of the call option does. It drops because it doesn't have any intrinsic value. And so all of the value at that time is coming extrinsically, and that's all based essentially on the probability of the price being able to rise back into the money. That is to say that the price rises above the strike price. And as the stock starts to climb back towards the strike price, you can see that the value of the options also increases. And as soon as there's a point here where the purple line, the cyan line, and the yellow line meet, as soon as the price of the stock goes into the money above the strike price of the option, the value of that option jumps. And as as the price stabilizes near that zone, what happens is implied volatility drops, all right? Because the move is clearly not continuing. And so it becomes more and more certain that the price isn't going to move any higher. And so the extrinsic value on that volatility is lost. And so the price of the options contract comes down. And you won't see that price rise again until that cyan line starts to move up and take off away from that, and take off away from that strike price. And then the price dumps. And what happens? The extrinsic value and the intrinsic value fall off the face of a cliff as the stock price begins to dip and retest that strike price. Now, I wish I had a pointer to show you on the screen. Maybe I do even. Maybe it's maybe I need a laser pointer? Oh my god, yes! Okay, so this is what I was talking about right here. You have the price of the stock, right? And as it crosses right here, you see the value of the option explode and come back down. And as soon as the price falls below that for a significant period of time, the value of the options contract decreases as well. And here you're going to see that even as the stock price creeps back up into the money, that the value of this call option hasn't quite reached prior highs, not even nearly. And this is due to theta, the time decay, right? The likelihood that we get back up and stay back up in that range decreases as the price fails to do so. And so what you see is that the price comes back down and bounces off that 40, and you can start to see the value of this contract rise again. This is going to be implied volatility and extrinsic value, and a little increase in the intrinsic value, because the intrinsic value is only going to be less than $1, right? Because the price didn't close above 41, closed at 40.87. And this is why I watch implied volatility so much. Should we see a big boom in the stock price, all of a sudden the premium will reflect intrinsic value, and that intrinsic value this late in the game will dwarf the extrinsic value because it's decayed with theta. And as implied volatility increases on a big run like that, that volatility will give value back into the extrinsic. This is what I've been talking about, is this relationship. And you can see that the value, the percentage gains and losses of the call option oscillate or moves much more wildly than the stock price does. I happened to be able to snag some of these calls here, December 3rd $4 calls, and then I held through this spike, and that was dumb, right? And now I'm in a less advantageous position, but my analysis does support that the price should be above $40 by this expiration date. So that's how I use my technical analysis to inform my options contracts buying. Obviously, if the market's handing you money and your position goes green, if it's an options contract, holding on to that might not be wise. You can always take profits and then re-enter a new position. And that's something that I don't do very proficiently, but I'm trying to work on that. So this was my first video about options contracts. We talked about the two kinds of contracts, what it means in terms of value, and how you can use them in your trading. I hope this was a good place to start. Tomorrow's video is going to be a little more interesting if you already know what all of this is. And stay tuned for more updates.